Hey guys, and welcome to Money Talks News, the podcast. This episode, we're talking about what to do when the market falls and your retirement account falls with it. We all know last year was terrible for stocks, with the Dow, S&P, and tech-heavy Nasdaq all posting double-digit losses, and that showed up in most retirement accounts. Definitely showed up in mine. According to Fidelity, just in the third quarter of 2022, 401k balances were 23% lower than the year before. That's a lot of loss. And that makes for stressful saving, especially for those nearing retirement. So what is an investor to do? That's what we're going to find out today. I'm Stacy Johnson. As usual, my co-host will be financial journalist Miranda Marquit. Hello, Miranda Marquit.
Hello, Stacy Johnson.
Listening in and sometimes contributing is our producer and novice investor, Aaron Freeman. Hello, Aaron.
Hello, guys. How you doing today?
I am flawless. Thank you for asking. And
Perfect.
This week, we are also joined by our special guest, Robert Gilliland. Did I say that right, Robert? Gilliland?
Perfect.
The Managing Director and Senior Wealth Advisor with Concenture Wealth Management. Welcome to our show, Robert.
Awesome. Thanks for having me. This is great.
It's going to be fun. Now, Robert is going to help us navigate our retirement accounts during a bear market. And I need this, Robert, because I'm near retirement and my account did suffer last year. Now, before we start, folks, this is not financial advice, so make sure to do your own research and consult your own experts before acting on anything you learn here. In short, don't sue us. Okay, now let's go ahead and dive into today's topic. First of all, Robert, give us a little bit of background about who you are, why you're here, what makes you the expert that you are.
Well, I'm a Robert Gilliland in Houston, Texas with Concenture Wealth Management. We started, and believe it or not, my timing was impeccable, February of 2020. I had spent the prior 25 years with a major wirehouse right here in Houston and realized that I wanted to be on the same side of the table as my clients and moved over to be an independent financial advisor. On my team, we focus 95% of our time working with people who are pre-retirees and as they move into retirement. And really what we focus on is helping them go through and create that income stream so they can live the life that they want to, not have to worry about the day-to-day management of their portfolio. So we focus a lot of time in exactly what we're talking about, retirement planning and where are we and what do you do now?
Yeah, you said something intriguing that I want to circle back on just for a second. You said you quit a major wirehouse, which means a big stock brokerage firm for the uninitiated. I worked for E.F. Hutton back in the day,
Okay.
Robert, and I started my career in 1981, which was when interest rates were 20%. So it sucked to be a stockbroker back then. Anyway, you said, but you wanted to switch and get on the same side of the same side of the table as your clients. What did you mean by that?
What my experience was, in my last 3 years, I was part of 12 people who would meet on a quarterly basis with senior leadership of the firm. And I started to kind of see how the sausage was made. And I realized that there was a big corporate mandate to talk to people about lending, to talk to people about banking, to talk about people about this product or that product when it may or may not make sense for them. And so I wanted to be able to align myself and make sure that we were a fiduciary, where we could truly act as a fiduciary and truly go and be held accountable, where it was at one point, the needs of our clients must come first. That seemed to kind of be the goal. I wanted that to be the floor. That's table stakes. We want to do better than that.
Okay, cool. So, now when I was a stockbroker, and I don't want to put words in your mouth, but the way I would tell people is that the way to get a corner office in a commission job is to generate commission. And that was the thrust, for E.F. Hutton or many firms like that. And there still are, commission-based firms. So what you're saying is that you don't get commissions on investments, right? You act as a fiduciary and put people in the right things, and and presumably you get a percentage of the
That's right.
account every year.
Financial planner. That's correct.
Yeah. So you're not motivated by commissions.
Right.
Cool. That's good, because
Yeah,
I would
that is
tear
good.
into you if you were. No, I'm going to tear into you anyway, Robert. So it doesn't
Awesome.
matter.
No.
Okay. So now
Let's
let
do
me
that.
imagine what it's like to be you right now. People are calling you up and they're going, Robert, holy cow, my account's down 30% last year. What the hell are you doing to me? Are you getting that call?
Well, no, because they're not down 30%. So that makes it sound pretty good, right? So the reality is that I think that when you're talking about investors, you really have there's two two segments that you want to that you're kind of talking about, right? One of them is that person who is either really, really, really close to retirement or already in retirement. So there's one course of action that you've got to take. The other is that younger person who still has a long runway. And so the advice and what we're doing are really two different things. So that person who is younger, we'll do that first. The reality is that the way you become wealthy is by paying yourself, continuing to make those 401k contributions, managing your debt, right? Making sure you're doing the right thing, continuing to save, because if you like to buy things on sale, making sure that you're taking the right risk, obviously. Things may be on sale right here, and it makes sense to be very, very disciplined. Making sure you're tracking and managing that risk becomes vitally important for that segment. For the segment that, let's call it 5 years before retirement, all the way into retirement, that's where you really have to start going through and doing your planning. And we call it the age approach. And you have to go through and look that any sort of plan needs to be adaptable, because what you think you might live on next year, maybe more or less, has to have growth, and you have to ensure that that money is available. And so you need to kind of go through and segment. Some people call it the bucket strategy. Segment those assets to make sure that money, and you need to make sure that you're taking the appropriate risk for what you're wanting to do and you're comfortable with that.
Okay, now let's use real examples here. Miranda is very young. She's in her early 30s. So what advice would you be giving Miranda if and we know this because Miranda won't stop saying it on every single podcast. She puts money in the S&P 500 index fund every month. And she's very well aware that, if it goes down, she just buys more shares. She's really happy with that. But what if she said to you, Robert, I'm a little nervous, because even though I'm young, I don't like opening an envelope and seeing my investment account down 15, 20%. What would you say to her?
Well, the one thing I would say is to keep the faith, and I would remind her about the long-term outlook for the market.
But she's freaking out, Robert. She's panicking.
Well, here's what reality is. 2022 was a bad year, right? It was a bad year. In fact, and this was actually kind of surprising when I was going back and looking at it, 2022 was the 7th worst year in performance of the S&P 500 since the Great Depression. 81% of the time after that bad year, the markets went up. That's number one. So that long-term perspective plays right there. But the other thing is that what I would remind Miranda is, if you go back and look, 4 of those, including 2022, have happened this century. And if in 2008 you got out of all of that and decided I wanted nothing to do with the market, you did detrimental harm to your portfolio. So maintaining that and continuing to do it. Now, if you're not comfortable with that risk, then maybe what you need to do is look at the diversification. Look at how you're spread out, because maybe what you want to do is continue to save, but maybe what you want to do is look to maybe add some sectors inside of there, because there's always things that are making money, right?
I like that idea of sectors. Yeah, I want to talk about that some more. But first of all, Miranda, do you feel better now? Are you a little more comfortable?
Yeah, I feel much better now.
Your undies are no longer in a bundle.
That's right. We try and keep them. Yeah. No, but I think that's a really good point, because a lot of people do kind of like, when the stock market goes down, because most people's 401ks, like most people who are invested in it, like most regular ordinary folks who are invested in the stock market, are doing so through their tax advantaged retirement account, right? They're doing it through their 401ks. And so a lot of the time people are thinking, hey, the stock market doesn't affect me. I'm not really invested. But then they open up their 401k statement. They're like, well, wait a minute. What did happen here? And then that's when they start to realize, oh, man, I am invested. And what's happening in the stock market does impact me. And so I think making sure people understand this is important. I think it's important for people to, 1, understand that their retirement accounts are in the stock market, and then 2, to understand the cyclical nature of the stock market, and the fact that even if you have a bad year, if you, as Robert says, keep the the long game in mind, you're going to be fine, right? Like if you look at any period, take any given 20-year period of the stock market, and overall the stock market, over any 20-year period has not lost. So like
it used to be 10-year period. Is it not 10-year period anymore?
It's probably a 10-year period. I just like using 20-year period because it's long and I know it's right and I don't have to look.
Almost no doubt. But but it's still okay. Now Miranda is a mutual fund person or an ETF person or whatever you want to call it. I'm an individual stock buyer. I'm in about 30 different stocks, and I've been doing this since You're of a certain age yourself, Robert. You've been in the round for a long time, and so I started buying stocks in 1981. And I still buy them now. And I'm much more successful as an investor than when I was a stockbroker. I'll tell you what.
Right.
In fact, I tell people this: ask any accountant if they do the income taxes of a stockbroker, and they'll tell you that almost universally they lose money every year because they have too much information. They're trading too much.
That's right.
So anyway,
that goes for couch day traders too.
Oh man, I'll tell you what, that's a dumbass thing to do in my opinion.
I have a question about that later. So
what is it? We can stop.
No, it's not the right. That's not the right period. Go on with your thing. But I have
so
a question
anyway, Robert, the question I was going to ask you was, what are you? Are you in it? Do you put your clients in individual stocks, or do you do sector funds, or do you just do ETFs? What do you do?
The answer is all of the above. So what I mean by that is, I think that going through and building a portfolio, whether you are pretty early or you are at retirement age, right? I think it all has to start with that foundation. Here's what reality is. When you're talking about big mega cap companies and stocks, information is readily available to everyone. You're never going to be exactly right in those broadly traded indexes, right? So you're better off paying attention to your expenses and owning think of it like building a house, a strong foundation in those ETFs and index type of investments. When, depending on the assets, from time to time, we will utilize actual individual stocks, utilizing managers and those kind of things, because you can get a little bit of performance out of those. And you have the ability to tax manage those depending on the amount and where it is, right? So there's some real advantages that are inside there. So we will utilize building that foundation, broad indexes, paying attention to sectors. Once you have that, then what you start doing is you become kind of tactical. You're looking at times where you're looking at a certain sector that has opportunity, the outlook is great, and as you kind of filter it through the global macroeconomic environment to the fundamentals, the type of companies that benefit to that, and then pay attention to the technicals, where's that flow of money, that gives you kind of an idea of where you want to move or move out of.
This is interesting. I actually just wrote an article, and I may quote something from it later, but it's where stocks are going in 2023 and where you should invest now. And I talk about sectors in that. But let me ask you this question. What about, and Miranda and Aaron will back me up on this. Last January of 2021, I said the market's going to fall. I mean, it sucks. It's time for me to ring the register because I have a lot of money. I've been investing for many years. Excuse me, I'm 67 years old. So I want to take some money off the table. I proceeded not to do that, though. I said it, but I didn't do it. But so my question to you is, I actually ultimately did in one of the bear market rallies. I sold about a third of my portfolio actually. But anyway, point is, you saw it probably. If I saw that, you saw this coming. I mean, when the Fed starts raising interest rates, you don't fight the Fed. You know it's going to hit the market. So, but now a person in your position, we would say. I mean, I would assume you say often, we don't try to time the market. No one's smart enough to know when the market's going to go up or down. We always say it. Well, how do you reconcile those two things? How did you not, when you see what's ultimately going to happen, how do you not time the market? Or what did you do?
Okay, so I can tell you exactly what we did. But the way that you do that is when you're going into periods of volatility, right? Which we knew in January, we were going into periods that we were going to be extremely volatile. We had finished 2021 with volatility, and now we have this extra. The way you get through that in that foundation is you need to be broadly diversified. So in March of last year, we paid attention to technical indicators and things like that. And in a big picture scheme, when the technical indicators violate or give us give us a window that, or show us that the markets have a propensity to go down, we will go through and create cash. So what we did from
so you're selling stocks. In other words, let's be really clear here. So you are taking money off the table.
That's right. We basically increased our cash exposure in March of last year up to 20%, depending on the client.
Okay, but you're still staying 80% invested in stocks, even though so 20% cash is a lot for you. It's not 80% stocks because we also have fixed income that's inside. Oh, right, of course. Okay.
Right. So we went from a 50 or let's call it a 60% exposure in equities down to a 40% exposure in equities.
Okay. So you did increase, but isn't that market timing?
The reality is that the answer to that is to a certain extent. It's not like we have to do this now and then all of a sudden we all have to go back in. But the indicators were that the trends were down, that we were going to continue to have downside. We maintained a long-term perspective in the overall portfolio. Okay. And so we took some chips off the table and built cash. It's much like loading the spring for when we start to get those indications, whether it's the Fed or the market show us, or unemployment gets to a number that shows that that the Fed is about to reverse.
And guess what I'm about to ask you, Robert? I'm about to ask you if you're going back in the market now, or if you still are retaining that cash. But don't answer yet, because we're going to take a quick break. I want everyone to be on the edge of their seat when we get back. Okay, so hold on. Now, this is time for us to pay some bills. So this podcast is sponsored by TELUS, the first savings app designed for home buyers by real estate experts. With TELUS, your savings earn more in one day than up to 3 weeks in a traditional bank savings account. What's more, there's no stock or crypto exposure, no fees, and you can withdraw anytime. Visit moneytalksnews.com/TELUS, moneytalksnews.com/TELUS to sign up. We'll also have a link in our show notes. And if you use the code MONEYTALK, you'll get a 6% APY for 7 days with as little as a $125 deposit. Okay, back to it. Robert.
All right, this might be a spot for my good question.
Oh, go ahead. Go right ahead.
Okay. All right. So obviously I'm a novice investor, so I'm really, understanding certain things about stocks, whatever. It's whatever. So in 20 and in 21, because everybody, everything went haywire, there was a huge amount of couch traders that just got into the market. And when you basically look at it in the stock market went like this, right? Because I think that snowballed hedge funds and it snowballed all kinds of things. When you look at a trend line, like any ETF, like the S&P 500, you look at a trend line like a 10-year, and you draw a line, it seems like the stock prices where they are right now, it's just normal trading. If everything was like average normal trading, they are right now where they should be. Is you guys agree or disagree? I mean, does that make any kind of sense?
I'm not quite clear on the question, actually.
Okay, the question is like everything seems right now today is like it's just normal every day where the prices are where they should be. And I, like last week, the Wall Street Journal had an article out about rookie traders are calling it quits. Their families are thrilled. You can see like everybody's pulled out. Like, all the newbies have pulled out.
So actually, Aaron, well, and Robert, please, your opinion as well. But what I would have said to Aaron is, when there's a lot of speculation in the market, which is what you had in 2021, and a lot of that was a result of zero interest rates, essentially. That's a bad sign. That signals a market top when everybody's taking out a second mortgage and buying stocks. I remember that happening in the year 2000 too. When I was working at a TV station, the weatherman goes, "Stacy, what do you think, man? I just took out a second mortgage so I could buy internet stocks." And I said, "I think you're a moron," and sure enough, this is when everybody's a genius, they're talking to each other at cocktail parties about how much money they're making in the stock market. You are really close to a market top. Robert, agree?
Oh, 100%. I had a professor in college told me that when your barber's telling you about a stock, it's time to sell.
There you go.
Right. So my question is now that everything's pulled back down, I mean, if you bought stocks today, the idea would be, wouldn't you be okay if you're thinking 20 years down the road?
Sure.
And then because they seem to be priced where they should be, and then if there is a dip, you buy more.
Well, actually, Robert, do you think the market is priced where it should be right now?
I think that we're going to continue to have volatility. You still, like what you said, Stacy, you still have you don't fight the Fed. The Fed is still raising interest rates even after The
Yep.
most recent CPI statement, there's still a 78% chance that in February they're going to continue to raise rates. The Fed has said they are going to stay higher for longer. The question that Aaron's asking is, given the pullback where we are right now, does it make sense to continue to add or to have put money to work and continue to add? The answer to that is yes, if you have that 20-year time horizon.
What if you don't? I'm 67. And I have considerable assets in the stock market, but way less than I did. I mean, I was 50% in stocks. I'm talking about my long-term savings, not just my retirement accounts, just my whole entire net worth. And now I'm about 25% in stocks. And I even have every intention of going back in, but I'm not doing it now. I think the market is still a little overpriced. So I could be wrong, but I also have a lot of money in the market already. So, if I'm wrong, I'm still going to win. But I'm holding back a little bit. Let me put this to you, Robert, and tell me what you think. The S&P 500 earnings estimates for 2023 are obviously range on who's doing the estimating, but somewhere around $200 to $210 for the S&P 500. Some higher, some lower. Let's call it 200 just for argument's sake. Okay, so if the market's trading at 15 times earnings, then 200 puts us at 3,000 on the S&P. We're now at 3,900. We're almost at 4,000 right now. So doesn't it? Okay, even if the market's at 220, I mean, if the earnings are 220, then times 15 is what? I don't have my calculator, but it's below where we are now. So
33. That'd be what, 3,300.
Yeah. So how would you respond to that? Do you agree? Disagree? Who cares? Buy anyway? What would you say?
So do we still have volatility ahead of us? The answer to that is yes.
When you say volatility, by the way, do you mean the market going down, or do you mean the market going
down?
up?
That's right. Yeah, okay. Going down and everything.
Okay.
Yes.
Okay.
Here, a couple points. Number one is that we haven't had the market completely wash out yet. In other words, the VIX, which is the volatility index, has not spiked tremendously. That tells us that there's still downward pressure.
Right.
That's number one. Right now, this period that we're in a period here for call it the next 4 weeks, 5 weeks, where all focus is going to be on earnings, companies and what their earnings are. That's backward looking. What's going to be important is what these companies are saying about their outlook. All attention is going to be paid to that. And as soon as we're out of earnings season, then we're going to start looking and paying a lot of attention to the Fed and the economic numbers and trying to read the tea leaves about where to go. So if you are a person, if we take Stacy, you as an example, and you have a lot of money sitting in cash and you are right here at the window or the doorstep of retirement, what we would do is that we would say, hold on, let's stop. Let's look at this. What is your income needs, right? How much money do you need to live on? Factor in taxes and inflation. We would go through and we would set aside money for the next 5 years inside of there. For monies for years 6 through 10, we're going to set aside that. So now what we have done is we've taken someone as they're right there at the doorstep of retirement from kind of being a short-term type investor. All the rest of that money can come over here into long-term. Now, that's not saying this money's sitting in cash, not doing anything. You got to do it so that it's working for you, whether that's in the 5 years, things that like CDs or very, very short-term bonds. In the 6 through 10, you can take a little bit of risk. But what that does is it takes away the worry about what happens day to day in the market. You're like, okay, do I have enough money to live on? Because it's all about those outcomes. Do I have enough money to live on? Have I factored in inflation appropriately? Have I factored in my taxes appropriately? And it gives you that freedom to not have to worry about it and to still be, without regard to your age, that long-term investor.
This reminds me of something that I've heard Miranda call the bucket strategy.
Right.
Yeah, it is the bucket strategy, and it works.
It does. And actually, this reminds me of something that I've said to a million people over the years, Robert. If you're freaked out about the stock market, you got too much money in it. It's just that simple. I mean, I'm not happy watching my investments go down, but it doesn't bother me. A, because I've done this for 40 years and I'm used to it. But B, because I don't have so much money in the stock market that I'm going to be in big trouble if something goes wrong. And this is why, and I mentioned this in the context of the bucket strategy, because you've got money for the next 5 years, and you don't have to worry that the stock market's, that you're going to need to sell something at a loss.
Right.
Right. And so that's how you position your customers.
That's right. And I'll tell you, when we started doing this, we didn't know that there was a such thing called a bucket strategy. It was had a client who retired in 1998, and they said, we want to keep 5 years worth of cash sitting in money markets and earning interest for us. I mean, at that time, it didn't really click. Well, we went through 2001, 2002. They happen to have a significant position in a company that ended up going out of business. So their net worth dropped, but they didn't have to worry because they still had those assets. As we move forward from, call it 02 to 07, they had this recovery. Then we maintained 5 years worth of money. Then we had the financial crisis. Today, they've got more money than what they did in 1998, and they've lived on it the whole time. So that we kind of fell into it and then realized there was a such thing as the bucket strategy. But that is exactly, that affords people at the doorstep of retirement the freedom and flexibility to do what's important to them.
Yeah, and I totally 100% agree with you, and I think that's really, really important. And I want to make sure, even for the people who've never listened to us before, because we've talked about this many times, but let's restate. As a matter of fact, Miranda, you've restated this so many times. Give us a quick update. What is the bucket strategy?
Yeah, so basically your bucket strategy says I want to make sure that I have access to the assets that I need for, whatever X years. Robert talked about 5 years. So you want to make sure that you've got, cash for the next 5 years or 3 years. I used it with my son's 529 where I was like, okay, this is what we're going to need for 2 years. And so I went ahead and moved that into cash. Because and then that way you have, okay, this is what I need for my immediate needs. And if the market goes down, then I have this protected stuff that I can get into that I've already sold high with. I've already realized my gains on it. And I have this money I can go into, and I don't have to draw on these other assets while the market is down and sell at a loss. And so the idea is to kind of, bucket things out into immediate, medium term, and long term. And as you use, as you reevaluate and you use some of your cash, then you look at it, like Robert says, you're always keeping 5 years of cash on hand. So now you need to pour from your medium bucket into your short-term bucket, and then you'll pour from your long-term bucket into your medium bucket as you go along. But the idea is, you have a little more flexibility in when you sell so that you're not freaking out and going, well, I'm retired and I need access to this money now, and so I don't have any choice, and there goes, now I have to sell at a loss at the beginning of my retirement, and oh my gosh. and then that, of course, affects you later on down the road. So the bucket strategy is just a nice way to make sure that you have a chunk of immediate liquid assets that insulate you so that you don't have to sell things at a loss when you need the money.
And by the way,
I'm going to do a bucket plug right here because recently I went to the Money Talks News Solutions page, which we have, and went through and tried to find the highest interest savings account. And I found a 4.3 or 4.4 APY savings account and threw a bunch of money in there. It's growing.
Yeah.
It's awesome.
It's astounding. I was just going to say that too, Aaron, because it used to be you put money in a money market fund because you didn't want to lose it, because it needed to be liquid. Now it's like, oh my God, the stock market's down 20%, but I'm making 5% on my savings with no risk, because I buy treasuries or are there other high quality bonds. So, this is a really great time. And in fact, I in this article that I was just talking about that I wrote about where stocks are going, I said, I've been investing for 40 years, never bought a treasury until a few months ago. And so what, Robert, are you advising your clients how about going longer term to lock in? Because if there is a recession, interest rates will probably come back down. Do you agree with that, Robert? And if so, are you recommending bonds?
So, yes, we do use bonds. Remember, if we're talking about this bucket strategy, each one of those buckets is going to have a different philosophy, right? So inside of that bucket for the first 5 years, we're going to be looking at things like bonds. We're going to be looking at things like CDs, things that...
Short term, though.
That's right. Very, very boring. In the intermediate term, we need to make sure that that money is available for you for years 6 through 10. Over here in the long term, we're going to have a smaller allocation generally to bonds. But one of the things that you've got to look at is that 11 out of the last 13 times that the Federal Reserve has raised interest rates, they've pushed us into a recession. Now, we can debate. I went to Harvard of the Piney Woods up in Nacogdoches and Stephen F. Austin State University. And what we were taught was back-to-back quarters of negative growth of GDP meant you were in a recession. Well, we had that in the first and second quarters. Third quarter was positive. We don't have third yet. So who knows when or if we're in a recession. But what will end up happening at some point, the Fed is going to end up having to cut rates, having to come down. And one of the things tactically that we're looking at, and it's way too early, for those longer term bonds, there may be the ability, not necessarily for income, but for capital appreciation on that fixed income. And so it really kind of depends. If this is in our long-term bucket, we're not looking at it for income. We're looking at that for capital appreciation. So in there, yes, we would look at long-term bonds because there is some opportunity. In the other buckets, we're gonna make sure we've got to do everything in our power to ensure that those funds are available for you when you need them. So we got to be relatively conservative, not quite as tactical.
It's cool. Yeah, it's nice to have high interest rates. And it's also, and now, you know what I haven't done yet? I keep waiting for rates to go up, and I haven't locked in long term. I'm in real short term stuff. And now, every time the 10-year goes lower, I think, well, I'll just wait till it popped back up where it was before. It was 4.5, now it's 3.5. So I haven't done that, but I have advised people, get into some longer term bonds. And for both for capital appreciation. Aaron, I'm sure you're aware of this, but just in case for those listeners who aren't, you know that bond prices move inverse to interest rates, right? So if the higher interest rates go, the lower long-term bond prices will go. And the reverse is also true, which is what Robert was just alluding to. If you've got a long-term bond and interest rates drop, that bond becomes more valuable. So you can actually sell it for a profit, as well as locking in a higher interest rate.
So it's still timing.
Yep. Yeah, it's true. So we're up. Unfortunately, the time went so fast today. But the bottom line, as far as I'm concerned, and I'd like to get yours too, Robert, but to tell people, obviously, it's concerning when your net worth drops 20%, obviously. But if you're panicked, you're doing it wrong. And you need to get some help or do a little more reading or something. So how would you conclude for us today, Robert? Do you agree with that?
Yeah, I think that it absolutely makes sense to take some time to go through and review your plan. Make sure that you're on track. I agree with you 100%. If you're nervous that you're going to go that everything's going to zero, you're doing it wrong, and you need to reevaluate. But it absolutely makes sense to go through and look and make sure you're comfortable with the investments. Make sure, like in 401ks, most of the time people just put it in there and they don't look at it again. Make sure that your setup and your allocation is correct. Make sure that your plan and keep score. The thing about the bucket strategy is it allows you to continue to keep score. You can see whether or not you're on track or not and make adjustments.
Cool. And we're going to tell people where they can find you too, Robert. And obviously there are many people that are really good at this. Robert's one of them. And you can do it yourself too. I mean, you can study and do this stuff. I find it fascinating, and I spend 3 hours a day researching this stuff just because I like it. But if that's not you, then maybe you could reach out there and find someone like Robert.
Sure, we'd welcome that opportunity to give our opinions.
Yeah. Anybody have anything else to add before we close?
It's one of the markers you guys look for. I was noticing there's a lot of articles on CEOs not buying their own stock, and CEOs actually literally telling people, don't buy anything. Our valuations are going to go down. I mean, was that a marker you would look at?
Yeah, I would. What about you, Robert?
Yeah, I mean, if someone's saying, do not own my stock, and I'm not doubting saying that I probably don't want to own it.
And likewise, though, when they're buying their own stock, that's often a good sign, too.
Yeah.
There's many reasons that CEOs sell stock, but there's only one reason they buy it. You can sell stock for any number of reasons. Put your kids through college, buy a new car, whatever. But you only buy it for one reason. I think it's going to go up. Anything else, Miranda?
Nope.
Robert?
Just keep plugging in there, kids. Keep plugging along.
Robert, anything else?
I don't have anything else. Thank you for this time.
Super fun. We appreciate your time. Okay, folks, speaking of time, we're out of it, but we're never out of topic. So dig a little deeper. You're going to find links to lots more info in our show notes. And remember, if your goal is to make more, to spend less, to retire rich, well, your online home is moneytalksnews.com. And don't forget to check out Miranda's online home as well. That is Miranda Marquit, MARQUIT.com. And of course, you want to visit Robert at his website. That is ConcentureWealth.com. I'm going to spell that, CONCENTURE wealth.com. You can find our show notes too. Got a question, comment, or topic you'd like to suggest? We would love to hear from you. You can email us at hello@moneytalksnews.com. And one last thing, if you like what we do, then gosh darn it, do something for us. Subscribe to our podcast. Takes you 2 seconds. Really helps us, makes our parents proud. So if you like us, show us and subscribe. I'm Stacy Johnson.
I'm Miranda Marquit.
I'm Aaron Freeman.
And you're supposed to say your name here, Robert.
Oh, and I'm Robert Gilliland.
I always forget to tell our guests that that's going to happen. Okay, thanks for hanging out with us, folks. We're going to see you right here next time.